Crude oil prices are back on the rise after the West slapped Russian banks with fresh sanctions. So, what are the best oil stocks to buy right now? Neil Dingmann is Truist Managing Director of Energy Research. Good to see you here, Neil. Thanks for hopping on. Before we even get to any picks, I imagine you have to come up with some form of framework here for oil prices. What is your short-term outlook for oil prices? How high can we see them?
Good morning, Brett. Thanks for having me. Right now, there's certainly at least, we think, somewhere between a $10 or $15 geopolitical risk. When you look right now, top worldwide producers, U.S. number one just by a fraction, Russia only about a 500,000 barrels behind, and Saudi about a 500,000 barrels behind that. All things considered, I mean, if this continues to last at least another month or 2 months, you could see at least another $10 or $20. So, our call continues to be, on a normalized average or fundamental average, closer to $80. But with this said, you could continue to see prices well over 100. In fact, we wouldn't be surprised to see a spike closer to 125.
Hey, it's Brian Chung here. I mean, we've been talking with other oil strategists and watchers who have been saying that these were secular trends that we were already seeing prior to the Russian invasion. I mean, even before all of this, WTI was at $85 a barrel. So how do you see the Russian-Ukraine situation playing into all of that? I mean, on top of the price increases that you're already expecting, is there a serious geopolitical risk that if this really kind of gets larger and it maybe perhaps spreads beyond Ukraine's borders, that there could be more further implications for oil prices?
It is a good question, Brian. I mean, what we could see that the supply demand was so tight, to your point, even prior to this, there was very, very little cushion. We normally have at least a couple million barrels in there. We actually right now we're running a little bit just the opposite, where demand was still overtaking supply. And so right now they thought with OPEC continuing to step up in the months ahead, that supply on its own would have stepped up, let's say by the end of this year. But obviously now, as I mentioned, Russia out there producing over 11 million barrels a day. If there's any retaliation that's energy related and they decide to go after Russian production, that's going to have, I think, a very quick and dire circumstance on prices and what could push it off. So, again, there's not any thought and suggestion that they're going to go that direction. That means administration right away. But if they do, I think this could have a very quick response of prices shooting up very quickly.
The market was a little bit surprised here, Neil, by what BP announced over the week, and of course, saying it would divest its close to 20% stake in Rosneft, the Russian oil and gas producer. Are there other? What's the Russia exposure for the other oil majors and Exxon, you name it? Might we see more Russian asset divestitures?
It's quite minimal. That was the biggest ownership, and they talked about that as potentially having to do a fire sale, which you hate to see for any company involved in this. But it is quite minimal. You could see U.S. companies that potentially have that have LNG, that export LNG, maybe something like that benefit. But as far as direct ownership, direct exposure, yes, there's some we have a little bit with Chevron and Exxon, but very, very minimal to their overall business.
What about some other stocks? I mean, are there any sort of companies on the E&P side of things that you like right now? I mean, obviously, this is a tough market to be picking individual stocks in, but are there certain types of names that you are really kind of dialed into?
Yes, I mean, I think besides these high prices, what's interesting, what I think investors maybe sometimes fail to realize, and why we were so bullish even prior to this, as you pointed out in another question, was most of now our companies have very low hedges. In addition to that, they have some of the lowest cost of capital they've had in years. A break-even price now around $30, where just a couple of years ago it was closer to $40 or $50. So companies that really fit that bill. Two of our, what I'd say even three of our top: Continental Resources, of course, famous oil man Harold Hamm running that. Number two, Marathon Resources here out of Houston, and number three, Matador. All three have those three counterparts. Obviously, nice high prices, no hedges, and a very, very low cost of capital.
Lastly, Neil, should Russia pull its production in any form, how do you think Saudi Arabia will respond, and what would be the corresponding impact to prices?
I think Saudi will try to step up in the quickest and most material matter that it's able to. but I honestly think that their spare capacity is more limited a lot of times than they're leading on. So, again, as I mentioned, Russia producing 11 million barrels a day. If even 2 or 3 or 4 million barrels of that 11 come out of the market, I think at best, maybe Saudi could quickly add 500,000 to 1 million barrels, but that would still leave us very short and cause prices to spike, I think, well over $125.
All right, we'll leave it there. Neil Dingmann, Truist Managing Director of Energy
you.
Research. Good to see you this morning. Appreciate it.